So let's go on to this big story. This is the Silicon Valley Bank collapse. We have all seen this in the news. It happened last Friday, March 10th. It is the biggest bank collapse since the 2008 financial crisis. So I'd like to spend a little time today discussing what caused this. What is going on? You know, when financial news comes about, people's eyes tend to glaze over. And by the way, I don't blame them. It can be boring. And certainly the newspapers do not do a good job of explaining economics to those who are not already well versed in it. So today I would like to give you a background, again, give you a little bit of a synopsis of what caused this and what the government is doing to remedy it in simple, understandable terms. So for those of you who don't understand economics, please stick in here with me because it is geared towards you. The background here is that the Silicon Valley Bank is actually the 16th largest commercial bank in the United States. It was founded in 1983 and it has a big footprint among tech startups. So most of its clients are those who are engaged in tech startups. The Silicon Valley Bank has called itself, quote, the financial partner of the innovation economy. As I'll talk about in a few more minutes, they're very big into ESG, which is environmental, social governance, responsible investing. So it seems like this bank sort of wanted to be on the vanguard and in vogue with progressive ideas and seemingly successful companies in the innovation startup world. In addition to the fact that this is the biggest bank collapse since 2008, it's actually the second biggest bank collapse in United States history, second only to Washington Mutual, which roughly had about $300 billion in customer deposits. At the end of 2022, the Silicon Valley Bank had $212 billion in customer deposits. The Washington Mutual meltdown occurred during that 2008 financial crisis. So it gives you a sense of what a big deal this Silicon Valley Bank collapse is. So what caused this? It requires a bit of a background on how banks work and the way that they make money. So banks have depositors, which are all of us who go to the bank, give them our money and allow them to hold it for us. And what the banks do is that they pay an interest rate, which is essentially a borrowing rate, to depositors to incentivize them to keep their money in that bank. And various banks compete to have higher interest rates that they pay to their depositors. So if you give $100 to Bank of America and Bank of America has a 5% interest rate, every year you will be getting $5 from the bank as payment for your deciding to hold your money in that bank. So Bank of America competes with JP Morgan Chase, it competes with Wells Fargo and other banks, which may set their interest rate at 6% or at 7%. Those seem a bit high, by the way. But it's just to say that they compete for interest rates that they pay their depositors so that their depositors will keep the money in the bank. The way that the banks themselves make money is that they take that money from their depositors and they make loans. Car loans, mortgages, other types of loans, and charge those individuals an interest rate that they pay the bank in order to get that loan. So what needs to happen is that there needs to be an interest rate spread, meaning that a bank wants the interest rates on loans to be higher than deposits so that they are making a profit. They want their people who they are lending money to be paying them more back in return than they are paying depositors to keep their money in the bank. So what happened with the Silicon Valley Bank is that they had too many depositors that they had to pay an interest rate or a fee to in order for those depositors to keep their money in the bank. And then their loans that they handed out to people were given at a fixed interest rate. So as we all know, because of this high inflationary economy, the Fed has been upping interest rates, which help cool inflation because, again, an interest rate is the rate at which you borrow. So when you raise interest rates, it makes it more expensive for people to borrow money because they have to pay a higher amount back to borrow the money. And if it's more expensive to borrow money, then people are not going to be as likely to do it. Then they're not going to be as likely to spend money. And that cools off economic activity and thus reduces inflation, which is, of course, high prices for goods. So with the Silicon Valley Bank, interest rates have been increasing because of inflation. So they have been taking in all of these depositors. In order to keep those depositors and compete with other banks, they pay those depositors a high interest rate. But then when they made loans a few years ago, they were making those loans at a fixed low interest rate when the economy was better. So they were probably making sure that the people who they were loaning money to were paying them a 2 or 3% interest rate, whereas they are paying their depositors more like a 5 or 6% interest rate. What they should have done, though a bank never wants to do this, you never want to turn away customers, what Silicon Valley Bank should have done is turned away some depositors and said, look, we would love to have your money, but we don't want it right now because we have too many depositors and we don't want to have to pay you these higher interest rates. So it led to this crash where the Silicon Valley Bank could not make enough money. There are other factors that people such as Vivek Ramaswamy, who wrote a great article in the Wall Street Journal yesterday, an op-ed about this Silicon Valley Bank crash. There are other factors that people like Mr. Ramaswamy say also caused the Silicon Valley Bank collapse. In addition to having too many depositors and not making enough money from their loans, Mr. Ramaswamy says that they had too concentrated a client base of tech startups. And tech startups, of course, are volatile. Few of them succeed. So he says that they should have diversified the people who they were doing business with. And also, as I mentioned at the start of this segment, the Silicon Valley Bank, sadly, not unlike other banks today, are big into ESG, that is environmental social governance or responsible investing. They have a sustainable financial group that monitors progress for things like, quote, the operational climate group, which again is apparently a part of the Silicon Valley Bank. This operational climate group seeks to, quote, implement operational greenhouse gas reduction initiatives. And the problem with ESG is that when banks are so focused on being PC and acquiescing to the demands of the left, they don't invest in things that may be profitable. They invest in things that may fall into this category of being socially responsible, abiding by environmental social governance. But the whole point of the bank is that you have a responsibility to your depositors. You have a responsibility to your investors if you're running a company to make good investments, to make a profit for them. That is more important than following a woke ideology or, again, investing in certain companies that the left may cheer you on for. You have to make money for your clients. And it appears that among other factors, the Silicon Valley Bank was too focused on ESG and not enough focused on running their management well. So on Wednesday of last week, the Silicon Valley Bank announced that it had sold off $21 billion in liquid investments. That would be as if you sold off your car or your clothes or other belongings that you have in order to raise money. And they also announced that they borrowed $15 billion. They organized an emergency sale of their stock to raise cash, which caused the next day, Thursday, the Silicon Valley Bank stock price to fall by 60%. That is huge. And also in the wake of it, other banks' stocks started to fall. The First Republic Bank in California fell by 16.5%. The Signature Bank in New York by more than 12%. The Zions Bank Corporation by 11.4%. B of A and Wells Fargo stock dropped 6.2%, while JP Morgan Chase stock fell 5.4%. So you may be wondering, why did this happen? The Silicon Valley Bank is the one that failed. Why were other people going and perhaps pulling out some of their deposits, which or which caused these stock prices of other banks to fall. The reason is, and this is why, as I'm going to get to in the moment, the government bailed out the Silicon Valley Bank. There tends to be a ripple effect that when one bank fails, people in the economy start to get nervous that the bank that they hold their money in is going to fail. And what we saw with the Silicon Valley Bank is once that announcement happened Wednesday, when the bank announced that it was selling off all these investments, that it had borrowed $15 billion, all of the depositors of the Silicon Valley Bank immediately went and started withdrawing their money to put it into another bank. But the problem is, this is true of any bank, not just the Silicon Valley Bank. A bank at one time does not have enough liquidity. It does not have enough cash to be able to pay back each of their depositors should those depositors want their money and go to another bank. So when you look at your bank statement, let's say you have $25,000 in your bank account. It's a little tricky, but that amount is essentially an agreement between you and the bank that if you want to pull out your money, they are going to give you $25,000. But in reality, while you are still holding that money at the bank, they take some of that $25,000 and they use it to make loans, they use it to pay their employees. And so when you want to take out your $25,000, they dip into other people's deposits in order to pay you. It's sort of the way the bank works. There's a lot of sloshing of money around. So when a crisis like this happens, when a bank collapses, all of these depositors come, they want their money back. But again, a bank at one time doesn't have enough liquidity to pay back each of those depositors, which causes the bank to fail. And that's why we saw some other bank stocks fall, because people get really nervous and they also try to pull their deposits out of the bank for fear that those banks will fail as well. So what is happening now to rectify this problem? As I mentioned, the government is stepping in, specifically the Federal Deposit Insurance Corporation. This is the FDIC. They came in on Friday. They took over the Silicon Valley Bank and they declared it into a state of, quote, receivership, which is what happens when a bank needs to be taken over by the government. The FDIC has a legal obligation to insure deposits up to $250,000 in a bank. So if a bank fails and you are a depositor and you have up to $250,000 held in that bank, the government will guarantee every penny of that $250,000 back to you. The reason why the federal government does this is because A, banks pay a fee to belong to this Federal Deposit Insurance Corporation. In case their bank fails, they want insurance that the government will insure at least some of their depositors' assets. But also, the government is doing this again to not create any panic. I like to use this analogy when referring to the way the economy works. I like to compare it to an airplane. So if you're on an airplane and there are 300 passengers and all 300 people really believe that the plane is not going to take off, it's not going to work properly. It doesn't matter if all 300 people on that plane, again, think that the plane won't take off. If the plane has the right equipment, the right pilots, the right fuel, that plane will take off, regardless of what the passengers think. The exact opposite is true of the economy. The economy depends on trust. You need to be able to trust your banks where you're holding money. You need to be able to trust that when you are buying or when you are paying someone, when someone is paying you, that money is legitimate and not counterfeit. You need to be able to trust that your investments are going to go well. An entire economy is knitted together through trust. So when a bank like Silicon Valley Bank fails, the federal government steps in because they don't want to create a crisis. They don't want to see all of these people around the country, again, pulling their assets out of the bank, not choosing to invest. It would be a disaster for the United States economy. So again, that is why the federal government steps in. So the Federal Deposit Insurance Corporation legally insures deposits up to $250,000. The tricky thing here, though, is that with the Silicon Valley Bank, only 11% of depositors would fall into that category. So only 11% of the total people who put their money into that bank are guaranteed by the FDIC to be legally insured to get all of their money back, which seems like a problem, but President Biden has come out and said, as recently as yesterday, that they will guarantee, they meaning the government, the Treasury and the Fed, will guarantee that the money goes back to all depositors, not just those 11% who fall into the category of being legally insured by the FDIC. The Biden administration is affirming that everyone who made deposits into the Silicon Valley Bank will get back their money. This both seems wise and a bit unwise. Again, of course it seems wise because A, those depositors deserve their money back, and B, as I said, you don't want to create a panic. You want the federal government to step in and provide some help so that our entire economy doesn't collapse. But the reason why it may be unwise is that, as Mr. Ramaswamy argued in yesterday's Wall Street Journal, this may incentivize some irresponsible behavior. He said that the federal government bailing out the Silicon Valley Bank, quote, creates an incentive for risky behavior, teaching large depositors that they can throw money at risky banks without diversifying or conducting diligence. That certainly seems to be true. Also, President Biden said that all of those depositors will be paid back not through taxpayer money, but through charging the banks higher fees to be able to belong to that FDIC, the Federal Deposit Insurance Corporation. So in other words, our taxpayer dollars are not going to be going towards making sure that those depositors give back their money. That is a bit misleading because if you think about it, if you're going to charge banks higher fees in order to offset that cost of the government paying back each of the depositors of the Silicon Valley Bank, how are those banks going to fund paying those higher fees? They're going to dip into their deposits. That's all the rest of us. They're going to dip in to the money that people put in that bank to pay the higher fees that the Biden administration is requiring in order to bail out the Silicon Valley Bank. So it seems that the Biden administration doesn't want to explicitly say that this is a taxpayer bailout or that this is a government bailout, but really, in effect, it sort of is.